In the middle of the last year, Seth Klarman gave an interview talking about the everything bubble. He spoke about how money was simply flooding into everything from stocks to crypto to SPACs, and everything was getting seriously expensive. Seth isn't someone who comes in front of the media very often. He's not a stock market predictor. In fact, he's an incredibly quiet value investor who barely talks to the media. But interestingly, he's one of the few people that Warren Buffett himself has said could reliably beat the market over time. He's also the author of the book Margin of Safety. He's worth about $1.3 billion. However, the interesting thing is that in the last year since he gave that interview, the everything bubble has only gotten worse. Starting from S&P 500, Dow, the Nasdaq, the mid-cap, small-cap, micro-cap. It doesn't matter, all of these indices are up by at least 30%, in some cases more. As a matter of fact, even natural metals such as gold and silver have also gone up by drastically. Since Seth Klarman warned us about the everything bubble last year, the bubble has only gotten bigger. It's important to highlight right from the get-go that how expensive the market has gotten in the past year and a half. Talking about the Shiller PE ratio, the market generally sits around 18 to 20, and that's the long-term historic average, which means the investor pays 18 to 20 times the earnings of the S&P 500 as a price. But today, however, we are looking at an incredible PE ratio of 37.27. However, having said that, there is no definitive saying that the stock market is going to crash, and it doesn't mean that you should sell. Now, looking at something like the Fear and Greed Index, we can see that 12 months ago, people were fearful. But now that has completely reversed. Not really bad just yet, but investors are feeling a little bit greedy. And that causes some problems for the investors in the long run, or at least for those who are value investors. Let's talk about enterprise value to free cash flow. Free cash flow is the simpler one to understand. It's simply the amount of cash a business makes in a certain time period minus the amount of the cash the business spends on capital expenditures to keep the business going. So it's the cash flow left at the end of the year, and the enterprise value is the market value of the company. But it also considers that as the owner of the business, you would also inherit the cash on the books, and you'd inherit the debt the company has. So the formula is simple. Enterprise value is equal to market cap plus net debt, which is total debt minus cash. The enterprise value is more like a comprehensive value of a business to use in your valuations. Now, value investors love a low enterprise value to free cash flow multiple. If you can buy a company at a price which is 8 times the free cash flow, that means you have made back that investment in only 8 years. The ratio as high as 20s or 30s can kinda suck, because that means we are gonna have to wait a long time before we have recouped our investment. And so the points stands the stock market's pretty darn expensive, so what on earth could investors do? How do you get around the everything bubble, especially when it keeps getting bigger? Well, there are the possibly 2 things one could do, which are you either accept that active investing in the US probably isn't going to work all that well, and instead just keep going with your passive investment strategy into ETFs, as per usual. Or the possible second thing one could do, if you are compelled to continue the Warren Buffett investing strategy, you'll have to do what great value investors of the world are doing right now, and you'll have to broaden your horizons, and may have to look into international markets as well. You will have to realize that when you're talking about the everything bubble, yes, in America, it very much is. But if you're brave enough to venture out and look at other markets, we think there are still some opportunities. However, looking at grand themes, it's okay to have a period of time where you're not investing so much, as we have heard from some of the biggest investors in the past few months that they would like to hold on to some more cash, especially during times like these, where the stock market in general could be extremely expensive. And we know that it's not super punishing strategy at the moment. It also wouldn't be a bad idea if you could hold on to some short-term US Treasury bonds. The yield on 3 months Treasuries is around 4.5%, so this doesn't seem a bad deal taking everything into account. And should something go sideways, it should be much easier for you to navigate through those times, especially you if held on to some cash. And now that the opportunity has arrived, you have positioned yourself to take full advantage of it. And so, to sum it all, a little bit of cash never hurts. But with all that said, it's the everything bubble revisited, plus what the world's best investors are currently doing about it. So overall, please leave a like on this video if you did enjoy it. Please subscribe,